Hi there everyone, good morning and welcome to this edition of The Market. I'm Avan Dabash, with me Nikunj, Dalmia as well as Anisha Jain. We've got lots lined up on the show, but first let's start off by giving you a sense as to how the screen is looking on yesterday's trading day, as we did manage to end at the day's high 17,800, and today of course is the expiry session, so bracing ourselves for quite a bit of volatility. And this at a time when we've seen Wall Street as well wrap up pretty much in the green. You had the Nasdaq as well, which did manage to rally largely on the back of a lot of shares like Microsoft, etc., that were abuzz in trade. But crude oil prices are clearly going to be the talking point, and that's largely on the back of the fact that they have been in the spotlight. Global growth concerns continue to weigh for 4 straight months on the trot. You're seeing crude oil prices that have been on the decline, and interestingly, from the start of the year, crude oil prices have declined 15% from those Jan lows. $70 per barrel is what Brent touched in the month of March, and this week alone, Nikunj, you've seen crude oil prices decline close to 5%.
No, this is after a cut by Opec.
Yeah.
Now, what Opec did, they came out, they cut the production, they wanted to ensure that they do not lose market share, and crude prices remained stable. But the demand crunch, and this is important, a cut by OPEC, crude goes up, but comes back to levels where the prices were pre-price cut or pre-production cut by the OPEC. So what we saw was more like a reaction, and now the numbness in the demand is bringing oil prices down. So even on a lower production, if oil prices are coming down, that is what is important for us. There are two things which matter here. The dollar index is at 101. Crude prices have gone below 80. Now, if you are an Indian investor, this is like symphony and Beethoven early in the morning, because this is what you want to see. You want to see weakness in the dollar index, you want to see weakness in the crude. That is a clear indication that demand globally or commodity prices globally are reversing. Implications for this, yes, it's a slowdown in the world, but I would say the implications of this for Indian macros are far outreaching in terms of the positives. We all know that lower oil prices is good news for us. We all know that a weak rupee, a weak dollar is good for emerging markets and good news for rupee. So that, I think, for me is the preamble, or I would say is the biggest moot point, that commodity prices are down, crude is down, and crude has gone back to levels of sub 80 where it was before OPEC announced a pre-cut. So 10% crude is out and 10% production is out, and crude prices have gone back to $80.
And what the RBI and the central government has the expectation of $95 to $100 what they have penciled in with respect to their current account deficit and fiscal deficit. So there's quite a bit of room available. So good news this morning coming in as far as crude is concerned, but it's getting offset by the weakness that we have seen in the global equity markets. And I'm talking about the weakness in Dow, because that slide almost 228 points in the trading session yesterday, and this morning to Asia and SGX Nifty is suggesting a bit of a decline. But back home, of course, the key talking point is the fact that today is the monthly options expiry. Over the last 3 months, we have seen a bit of a tepid move come in. We saw that big decline happening in Jan and Feb. March was something where we stabilized, but look at the bounce that we are witnessing in the month of April. It's a 5% uptick that we have seen this month already. And if you look at, in the years gone by, when had we seen this 5% move? Well, it's not very often. In 2021, there were 3 months when we saw surge of over 5%. And last year, there were a couple of months where we saw that the Nifty managed to gain over 5% in the years gone by. However, the saying, as we were talking about earlier, Nikunj, is sell in May and go away. It doesn't seem like it's going to happen this time around, right?
One should not do that. And markets are moving as per the script. This is pure classic way in which markets have moved in the month of April. From oversold to a zone where the desire to participate long is there. We are not in overbought, guys. We are not in a euphoria. We are not in an overbought zone. That happened in 2022. That happened in January 2022. This is not the market where you want to sell the rise. You want to participate in this market. So market movement, which I've been maintaining, and I'm sticking my neck out and saying that, and I did that in the month of April, that it was time to buy. I think it's time. I think it's too early to sell. I think that really for me is the construct of the market. From a breakdown to a breakout. From a breakdown to a breakout. That is how market positioning has changed. This is an important week, and this is a crucial week. There are numbers. We've been on the right side of the numbers. FI flows have been decent. Crude is strong and supportive. and you stay above 17,800, trust me, technically it changes the setting on the table. That is what is important here. The setting on the table has changed, and you add another 100 points on here, then markets will start talking about 18,100. So do we have a case for markets moving to 18,000 plus? I think this week the chances are strong.
Okay, that's the view coming in. So don't sell in May and go away. That's clearly going to be the strategy. Let's put the spotlight then on individual stocks, and no surprises for guessing that we're going to talk about earnings candidates because it's a very heavy earnings week. Today alone, incidentally, you have 4 Nifty 50 companies that will be coming out with their numbers, but let's sum up the big earnings yesterday. Bajaj Finance, and just taking a look as to what they delivered, overall it was a good set of numbers. You had the profits which came in above street expectations, asset quality improved, and it was an inline set. Maruti as well, you did see quite a bit of choppiness on the stock price, but at the end of the day it was an inline set of numbers. There was favorable forex movement, higher sale volumes, and that really propelled the PAT number, margins in line. SBI Life as well, while the gross premium income did come in below street expectations, the profits as well were low, but the VNB margins and the overall earnings came in line with street expectations. In HDFC Life perhaps was the only one that stood out as a number that was pretty healthy, as you had the overall gross premium income for Q4 that shot up 36% and the standalone PAT at 59 crore rupees. So Nikunj, clearly, as of now, what is being delivered when it comes to earnings all have been in line with street expectations, and of course today is going to be a critical day.
So what is important is the numbers are. What are the outlier? One outlier was Infosys. That was a company-specific phenomenon. The other outlier, I think, is ICICI Bank. That again is a bank-specific advantage. So the outliers perhaps do not tell you a clear trend per se, but for me there are more earnings which are in line, and in general there is more positive commentary, whether it is from Bajaj Finance, we'll discuss the numbers, or it is from Tata Consumer yesterday, or it was from AU, or for that matter IndusInd Bank. Managements after managements are coming out and they are talking about constructive outlook rather than a dim forecast. Constructive outlook versus a dim forecast. That was not true. A year ago, the narrative was war in the world, high inflation, we don't know what to do, we have to just, protect our, we have to hunker down the growth and margins were under pressure. That is not the narrative. Now what is the narrative? Markets have bottomed out. Margins are bottomed out, demand has stabilized, FY23 was challenging, FY24 will be challenging, but less of stress in terms of managing the macro conditions because the interest rate hike is also behind us. So the narrative is actually not bad at all. Just, you got to remember things in perspective, Anisha Avan. Same time last year, what were management saying? War in the world, high commodity prices, we don't know what will happen, whether it is Ukraine or Russia, whether it is crude or China, we don't know what will happen in the next 6 months. Reserve Bank of India was increasing rates, everybody was running scared with inflation. That narrative has changed with constructive, positive, decent visibility, margins are bottoming out, and demand has also bottomed out. That is a big narrative difference.
And demand bottoming out, rather the issues regarding that bottoming out is something which is right now impacting the crude prices as well, as we were highlighting earlier. So let's welcome on board Peter McGuire to make sense of whether the move in crude is short-lived, or is it going to be a bit more a bit more up in the range of around $75 to $80 going forward. Peter, hi, good morning. Thank you so much for making time. We are seeing a sharp decline in the crude prices in the week gone by. Do you believe going forward at least the $75 $80 is going to be the range, or do you see it pulling back to the levels of at least $80 $85?
Well, good morning. Greetings from Dubai. I think that we've seen that pullback has been very sharp, and I think it's been quite well received from traders as far as consumers are concerned, and that's a good sign, but producers aren't happy. We're worrying about probably the demand picture, inflation, and all of those concerns. I think the overall move will be higher from here, but it's certainly volatile, and it's creating much opportunity from trading perspectives.
So, Peter, what are you doing in Dubai?
Nikunj, I'm over here looking at the oil industry. I've been over to see gas exploration and so on. So it's very dynamic, as we know. It's the headquarters, really, and for global, I think, production. So it's just getting a little bit of a heads up, flying out today for Sydney, and I'm being short on energy. And over the last couple of days, it's been a great time to be trading it.
Expect OPEC to come out and slash production again, because that's the only way they would be able to maintain prices now.
I think you might be right, Nikunj, because I'm worried about that. If that's the case and that happens, then that's really going to create I think, a powder keg environment not only from the producer's standpoint, but the other side will be that if that's how it moves forward, and that coming into a summer driving season and certainly Northern European and Northern Hemisphere summer, traditionally more consumption, that's really going to create angst for consumers. And I won't be surprised if that was the strategy that may be delivered over the next month or so.
Peter, do you think that the market to some extent as well is questioning the validity of OPEC's recent production cut amid the fact that we have strong exports of Russian crude?
Yeah, I mean, that's a concern, certainly. So I think there's so many different components to this melting pot, and we understand the Russia situation. So it's hard to pinpoint where their strategy is going to be and where the overall themes are, but there's so many differing viewpoints and differing. I mean, you only got to spend time with oil exploration or oil people, and everyone's got a different opinion of where they see oil prices in the short to medium term. So it could be that, we see a little bit further downside, and I won't be surprised to see this volatility remain.
All right. We really appreciate your time. Enjoy your stay in Dubai.
Thank you, Nikunj. Bye.
Crude is at $79, $78. Yes. 130 same time last year. What a fall it's been. There you go. Look at that chart. December 2022, it went to $76, and it's come back almost to $76. So directionally, crude is headed lower, which is what matters. Brent went to $71. I didn't realize it. It went to $71 this year.
Crude oil prices.
Yeah, I mean, that's what the chart says. Unless the chart's wrong or our memory is...
I'm guessing it must be last year 71, or okay, it did touch in between the year in March apparently.
$71. It's just that when you look at the data, you realize it.
Yeah.
But directionally, will it go back to $71? Okay, Naresh, what should we start with? Nifty or a view on crude? Because crude is now getting decimated.
So I would say we are forming a new range on crude. It would be tough to break that $68 to $71, which was recently made. And similarly, it would be tough to take out $90, $95. And a sideways crude is a better condition for us rather than a $50 crude. So technically, as of now, it looks like a formation of a new range and getting back into a range, and it could stay for a long time. So my expectation is we stay between 70 to 90 for a period of time.
Nifty, are we on the other side of the trade, getting ready to come out of the range?
So it looks more probable going forward that we break above that 17,800 and 850 mark and test that 18,100, 200, which is the next resistance. So for now, we keep a stop loss at 17,600 and expect a move towards 18,100, 18,200. We'll have some bit of a results left over the next 1 week. And post that, we could get into this move. One interesting thing is over the last couple of sessions, even though there has been a dip in the global markets, Nifty has started outperforming. That's a strong indication. Overall, all the risk parameters we look at, the dollar index has not taken a rally. So it's a result effect across the world in a lot of places right now. But the trend is pretty clear. Till the time we hold 17,600, I would expect a move towards 18,100, 18,200.
Let's find out those individual stock strategies as well. And Naresh, what is it that you're picking out for the day?
So looking at stocks with a mix of large caps and mid caps. So first is a buy on GAIL India, and the stock at 110 levels. If you adjust it for the dividends, is 1% away from an all-time high. In the short term, the stock has been consolidating in a very tight range, say between a range of 107, 108 to 110.5. So that's been a 3-4% range for the last couple of weeks. It is setting up for a flag breakout. Breakout in this way would actually initiate a new trend out here. Expecting a move towards 125 levels in the short term, stop loss at 106. Second is a buy on Apollo Hospitals. Over the last 1 year, 1.5 years, the stock has underperformed the whole hospital segment. The rest of the smaller names, the mid-cap names, have done really well. The stock has been consolidating around that 4,400 mark for quite some time. over the last 1 week or so, it has been trying to test that 4480 resistance. Once it crosses that 4480, 4500 mark, we could make a quick dash to 4900. So an accumulate at current levels with a stop loss at 4250 and a short-term target price of 4900.
Okay, so that's a take coming in as far as the top recommendations at this point of time. But let's welcome on board Kunal Bothra as well. Kunal, your take as far as the market is concerned. Yesterday we saw that solid surge in the last hour or so. Do you expect that momentum to continue?
Well, had we opened with a gap up of 30-40 points, and I'm sure that we could have seen a very strong follow-through price action, because today being the expiry day for the monthly series, it's going to be very crucial that those strong resistance points where call writers or option writers, they generally it act as a hub. That's a zone where we see a massive unwinding. So assuming if we scale past, say, about 17,850 mark on the spot levels, then I would expect a major recovery as well as a very strong pickup of price action, a strong unwinding from short positions, and that could probably have scaled the index further another 150 points higher. But then I think we may have to wait out for maybe another couple of days for that to happen. Net, the view is bullish on the index. We've managed to protect that 17,500, 550 mark as a support previous week, and we've scaled on, in terms of individual stocks as well as sector trends. So I think overall trend looks to be extremely positive.
Okay, a positive trend in place. So in light of that, then Kunal, are you going all out and picking out large caps, mid caps across the board?
Yeah, so mix of large caps and mid caps. Titan is one of the stocks which I believe was very resilient throughout the day yesterday, especially in the first half when the markets opened on a bit of a softer note. So I think that's an interesting chart in the making, heading towards a swing breakout, suggesting a buy on Titan, targets of 2,750, stop loss at 25.75. And the second would be a buy on DLF, a stock which I've been extremely bullish on. I think even at current levels, the stock is placed extremely attractive in terms of risk reward as well as in terms of the positioning of the trend. Would suggest a buy. 440 could be an immediate target, and stop loss could be kept at 400.
Okay, so those are the top recommendations coming in. Real estate is something that Kunal thinks that still has steam, so that's why DLF is one of his top recommendations. But what's the fundamental opinion coming in from Sunil Tirumalai, the research analyst, emerging markets and India equity strategy at UPS? He says that he's not at all worried about banks' asset quality and believes that they could probably see a further upside from here on.
So the peak of margins is what I think I would definitely agree with, and that's what even our banks team have been talking about. But on asset quality, it doesn't seem like we should be worried, at least from a 12 to 18-month perspective. If you look back historically, asset quality cycles have been the bigger drivers of banks' performance than just margins, right? And you would be worried on the stocks if they were trading super expensive at a big premium, and hence even the correction on margins is a big risk and you have to get away from the sector. I don't think we are at such a situation right now. So we actually have banks as one of the most preferred places for us in the market. Primarily because the credit growth, given the kind of nominal GDP growth that we have in India and the penetration levels, I mean, you'll get decent credit growth. We should be more focused on asset quality cycle, and that's where we should be kind of comfortable from the next 12 to 18 months perspective. And I wouldn't use the margin speaking and coming off as a big sell argument on the bank sector. I think the valuations are quite compelling given the context of where the valuations are in the rest of the sector. We are heading into a good time, I guess, for the consumption sectors. I mean, generally, in a disinflationary environment, commodity prices have come off already, and there are more that could happen for some specific commodities for some specific stocks. So generally, we are heading into a good season or good period for consumption sectors. We choose to prefer the staples over discretionary. Given where the valuations, how much to the extent valuations have corrected, and the sensitivity of the stocks to rates. I mean, in our work, we found that surprisingly in India, the staples stocks are more rate sensitive, especially when we talk about rates in the US, and which is where our house views are rates to come off significantly, and hence the tailwind support on valuations could be bigger for the staples sectors, against the discretionary sectors. And I think, I think it's a good time to look at consumption, but I think we would prefer the staples rather than discretionary.
We did hear from the cabinet that they've approved the national medical policy as well. Let's try and understand the implications with Mr. Himanshu Bed. He's the MD at Poly Medicure as well. Himanshu, hi, good morning. Thank you so much for making time and speaking with us this morning. The cabinet has approved the national medical device policy. Could you talk to us about what could be the key highlights, what are the synergies, and what kind of impact do you envisage for Poly Medicure?
Good morning. I think this is a big boost for manufacturing in the medtech industry. Medtech industry was always part of the drugs and pharma industry. If you look at the regulations and, if you look at the policies, they were all pretty much similar to pharma industry. And now I think Department of Pharma has carved out a new policy for medtech sector. It was long overdue. We had a first draft policy in 2015. And since then, I think it went to a lot of iterations, and also a new Medical Device Act was also envisaged in between. So I think regulatory harmonization is the big key here, takeaway, where states and center will be in a harmonized way looking at the regulations. India will also be aligned with GSTF regulations, which is like US FDA, European regulations, Japanese regulations. A lot of alignment will happen there. And I think if we see a boost in manufacturing, I think definitely there will be a boost in exports. There's also a new Medical Device Export Promotion Council, which is planned. So all in all, I think it's pretty good for the industry.
So since you're talking about this is quite good for exports as well, what's your own exposure, if at all, to exports at this point of time, and what's the strategy of tapping into that opportunity?
See, our exposure is around close to 65% of our total revenue. And I think with this policy, I think we'll see the fine print. We haven't seen the policy as yet. We've only seen some highlights. Once we see the fine print, I think with the Export Promotion Council, being established for medical devices separately, I think specifically we can go to regulated markets, highly regulated markets, and with some government support, we'll be able to actually increase our exports in those markets.
Okay, and just Himanshu, before we let you go, I understand that you had earlier laid out a guidance of growth of almost 20% plus in FY24. Can you talk to us about whether you're on track with respect to that growth? Is it possible over the next couple of years to grow at 20% plus CAGR? And what about margins?
See, I think I'll still stick to the FY24 guidance, and we are pretty hopeful that we should grow over 20% because we see good headwinds in India, tailwind in India, and also, tailwinds in Europe and US markets. So we're pretty hopeful about that. And I think margins should slightly improve because the raw material prices have cooled down. Also, the supply chain has eased off. So I think this should actually help us to improve our margins in coming quarters.
So given that you've also forayed into the dialysis category under the PLI scheme, can you just give us a sense as to how things are progressing on that front?
See, it's been a little slow start, not as we anticipated. Though last year we grew around 40% in this segment. This year also we plan to grow over 40%. We have some headwinds coming from Chinese importers where they are pushing low quality products in India, and maybe at also at very cheap prices. But I think as the regulation and the policy gets strengthened, I think we would see maybe a clamp down in that area, and it'll give a boost to local manufacturing.
All right. Thank you for joining in and giving us a sense as to what exactly the cabinet nod for that national device policy means for the space and for your company as a whole. All right, let's get a move on then and focus in on all the earnings. Bajaj Finance reported a jump in their new loans booking in the last year, going up over 29 million. Let's break down the quarterly numbers and understand how the performance was in Q4. Vamakshi joins in to give us that perspective. Morning, Vamakshi.
Bajaj Finance, a good show of a good show as far as numbers are concerned for the fourth quarter. Let's break down the numbers for you. Net interest income came in at around 6,255 crores, which is slightly above what we were penciling in. Apart from that, when you look at the PPOP, that was, however, in line with estimates, coming at 5,119 crores, and this is an uptick of nearly 29% on a year-on-year basis. When we look at the provisions and write-offs, they stood at 859 crores. Again, this was slightly higher than what we were expecting, but PAT, that has seen a good uptick of nearly 31% on a year-on-year basis and stands at 3,158 crores, which is much better than what we were expecting. Apart from that, the asset quality for the counter has also improved. When we look at the GNPA, that has come in at 0.94%, and this in fact is the lowest level in the history of the company. NNPA stands at 0.34%. Apart from that, when we look at the core AUM growth, that has seen an uptick of 29%, and absolute AUM increase was the highest ever seen in quarter 4. Number of loan books also saw an uptick of 20%. Customer franchise stood at 69.14 million. Annualized ROA 5.4% in Q4 versus 5.3% that we saw last year. So slight bit of an improvement here. ROE has also seen a significant improvement of almost 100 basis points to 23.9%. Apart from that, the management also came out with a very good, strong commentary as far as FY24 is concerned. They have in fact given a growth guidance of nearly 28 to 29% for FY24, which is much higher than their medium-term guidance of 24 to 25%. They believe that the growth is expected to remain strong, but the focus will now be on the margin trajectory. They're expecting a moderation of nearly 40 to 50 basis points in FY24, resuming one more policy rate hike. In fact, this is the highest ever customer franchise addition, and they're expecting to add nearly 11 to 12 million of new customers in FY24. All products and services are now live on their web and app digital platforms, and in fact, we have a few brokerage notes that came in on Bajaj Finance, and they're highlighting that JP Morgan in fact is saying that the company has surprised positively on the margins. Asset quality continues to remain solid, while the and this in turn justifies the valuation premium that the company has versus top private banks. Morgan Stanley says that the rates likely peaking should be a tailwind for the counter, and given all these positive factors, JP Morgan and Morgan Stanley both have maintained an overweight rating on Bajaj Finance. So overall, a good show from Bajaj Finance.
Well, yes, the pace of growth really continues, almost a 30% growth when it comes to, the profitability metrics. So really a stellar set. And the commentary also on the con call was quite positive. They are saying that April has started on a good note, and they're quite confident of the growth in FY24 as well. Listen in.
Gross NPA, it's the lowest ever in the history of the company. And if you adjust this to 180 days past due and so on and so forth, I think these numbers are ever low numbers. Net NPA came in at 34 basis points, ending March 23. Very quickly on full year, given that it's a fourth quarter, excellent year overall across all financial and portfolio metrics. We delivered a core AUM growth of 55,292 crores. We had guided for 52 to 53,000 crores of AUM growth in the beginning of the year. We disbursed 29.6 million loans. We added 11.6 million new customers to the franchise. Highest ever customer addition that we've actually done. We are pretty confident about growth and portfolio metrics for FY24. App platform has fully gone digital across all products and services. It's going live in a staggered release manner.
All right, Bajaj Finance aside, HDFC Life as well announced its numbers yesterday. Profits meet street estimates, but it was a pretty decent set of earnings. That's HDFC Life. And let's find out what exactly the company delivered. We've got Harsh Satya who joins in with the details. Harsh?
Well, yes. We've seen good premium growth, and that's largely in line with what we were anticipating or penciling in. In fact, gross premium income has come in at 19,626 crore for Q4. We were penciling in a number of around 18,000 crore, so it's gone up, or rather it's higher by around 10% or so. So that's one piece which is quite impressive. Value of new business, though, has also shot up much better than anticipated. It's come in at 1,511 crore for Q4 versus the 1,100 crore odd number we were working with. And it's a solid 68% jump on a year-on-year basis. VNB margins have come in at 27.6%, largely in line with what the street was penciling in. And what we're also seeing is that the standalone PAT is at 359 crore versus the 358 crore number same time last year. So no changes there. But with regard to what is really leading the gross or the premium income higher as well as the new business higher is on the back of the fact that those tax changes have come through. And for higher value 5 lakh plus policies, there was a limit of up to 31st March where it would have been non-taxable, and that's what's really leading the tailwind for HDFC Life, it seems. But solid set on the premium income growth, steady set on the VNB margins is how I would put it.
Okay, Harsh, so that was about HDFC Life, a number coming in better than what Street was expecting, but was it a similar performance from SBI Life?
Right, so SBI Life's gross premium income has come in at 20,000 crore. We were working with a number of around 21,500 crores, so slightly short on that front. But the new business premium number has come in exactly in line with our estimates. We are expecting 1450 crore. It's come in at 1440 crore. In fact, the margins have actually come in better than what we had penciled in or what our poll indicated. Margins have come in at 30.1%. This is full year FY23 margins versus the number we were working with was 29.1%. So we've seen a 4.2% uptick in terms of margins for full year FY23 versus full year FY22. So that's one positive that I would take out of the result. Profit after tax has come in at 775 odd crore versus 672 crore same time last year, which is a 16% jump, and PAT has also come in slightly lower than our 830 crore estimate. Let's look at the full year numbers, a couple of them at least. The 13-month persistency has come in at 85.5% versus 85.2% on a year-on-year basis. The 61-month persistency has also improved quite solidly. 55.6% is where that number is at versus the 49.5% number same time last year. Let's also, largely it looks like an inline set of numbers, slightly lower on the gross written premium but largely better on the margin front.
All right, that's SBI Life for you. And in terms of what exactly the brokerage had to say, you have Goldman Sachs, which maintains a buy with a target price at about 15.10. In fact, let's hear out what the management as well had to say in their conference call.
Numbers are the direct outcome of the scale, quality and spread of SBI Life business across the regions and the fundamental requirement of maintaining high quality, consistent and sustainable business model. The company gained private market share by 92 basis points to 24.3%. On individual rated new business premium, we stand at 152.2 billion with a growth of 18% over the previous year, while maintaining our leadership position with private market share of 22.3%. Group new business premium stands at 86.8 billion with a share of 29% in new business premium. We have collected total new business premium of 295.9 billion, registering private market share of 21.3%. The renewable endeavor to maintain our leadership position and continue to further increase our market share by offering products that meet the evolving needs of our customers. With our widespread, robust distribution network, complemented by digital technology, our innovation strength and above all, our people power.
Okay, so that's a word coming in from SBI Life. But on that note, we are slipping into a very short break. As we do that, listen in to the fundamental bets coming in from Hemang Jani.
Upgraded the realty sector. So Godrej property is something that we like, and we think that though the business traction was very good, somewhere the stock corrected by almost about 40% because the profitability had its own toll. And recently, when the interest rates started inching up by more than, let's say, 225 basis points, people had their own doubts about how sustainable this entire real estate story will be. But now that there is a pause and the overall guidance from the management continues to be very good in terms of what they will deliver with a focus on profitability. So that is something that we like. And apart from that, the NBFC space, I think, would have a positive rub-off of this entire, rate pause. So something like Poonawalla FinCorp, M&M Financials, I think these stocks should do well, because of the fact that the interest rate environment is going to be far more favorable.
On some more stocks which will be in focus today, Gujarat Gas is one of them. It will be in focus on account of the second round of price cuts that the company has taken. Let's go across to my colleague Somit to understand what the impact is going to be.
Well, if you see, Gujarat Gas has cut the gas prices for the Morbi region specifically by around 5 rupees per SCM, and this will be effective from 1st of May. So the effective prices would be around 39.5 if you're taking a 3-month contract, and if you're taking a 1-month contract, then the prices would stand at close to 40.5 rupees. And this is the second price cut that the company has taken in the last 1 month. The earlier price cut was of around 3.5 rupees per SCM. For the non-Morbi region, the gas prices continue to remain steady at around 48 rupees per SCM. Now, what does this price cut mean for Gujarat Gas? This clearly shows that the management is now prioritizing volumes over margin. Now, in calendar year 2022, the management was prioritizing margins over volume, which led to a 70% drop in the Morbi region's gas volume from around 7.3. It came down to around 2 MMSCMD in the previous quarter. Now, given the fact that they are prioritizing margins, volumes, it doesn't mean specifically that the margins would be hit for Gujarat Gas. Now, what analysts are suggesting is that post the current price cut, the gross margins that the company would be earning would range in around 1.1 to 3 rupees per SCM, as against 13 rupees per SCM gross margin that the company reported in the previous 2 quarters. So that's a sharp drop on the margin front. Also, analysts are suggesting that even after this price cut, the propane prices would continue to remain cheaper and compared to gas at around 3%. So there could be further price cuts even going forward. So what do we need to watch out for from here on? On 10th May, the company would be announcing its results, and we'll have to wait and see what the Q4 volumes were and the margins were, and what the management is suggesting on the current margin trends and the volume trends, and what is their strategy going ahead would be important to watch from Gujarat Gas earnings on 10th of May.
Thanks very much for giving us those details on Gujarat Gas. Let's move right on then and focus in on the stocks on the editor's radar. And clearly, Nikunj, with the way crude oil prices are trending, those OMCs are in the spotlight.
I think there's a trade there. I always say that you never invest in OMCs with a multi-year view. You always buy them when there are tactical patches in the market. I think there's a trade in OMCs, and I'll tell you why. Crude is down, oil rupee is stable. Very simple. Crude is down, oil is stable, and OMCs have not cut prices. OMCs were losing money same time last year, left, right and center. Interestingly, even though oil is down, refinery cracks globally, they've not come down. So refinery cracks are strong. The export, which was the export duty, which was there when crude prices went higher, which came closer to Diwali, that's been rolled back. And now if oil marketing companies, if they make money, which they will at the current juncture of oil, I think FY24 numbers could be significantly better. I think there's a trade there because these stocks are cheap. There's a trade there. Why? Because markets, they right now in terms of accumulation or ownership, it is just not there. So this is one space which should be on everyone's radar. Very simple. Crude falls by $5. ONGC and Oil India may take a hit, but there are a lot of other companies from the OMC packet which would essentially gain. I mean, that's the standard stuff. Our paint, aviation, tire industry would benefit, but OMCs is what you should focus on.
Nikunj, I also wanted to understand how you're looking, how one should approach the IT sector, because we were discussing it yesterday as well, the dichotomy that we have seen in large caps versus mid caps. The large caps have delivered a constant currency decline from 3% to flat, whereas the rest of the mid cap IT has delivered what, plus anywhere between 2 to 8%, and the guidance is what, 27 to 30% for KPIT Tech, for instance, and Infosys is talking about 4 to 7% growth.
So the outliers, one will say I'm sounding repetitive, I need to think of one line, but that is the way it is. Infosys.
No, but even TCS, HCL for that matter, HCL's guidance is what, 6 to 8% versus 27 to 30%. Again, even if you keep, kick off KPIT calling it an outlier, rest of them are calling it double digit.
Mastec
Yeah,
numbers
exactly,
were very
10
decent.
to 20%, everybody's
That is what you must realize, that the Indian IT sector is no longer this body shop model. There used to be a view that Indian IT companies are more like a body shop and an arbitrage model where they were simply working on the cost arbitrage model. I think that is clearly out now. What is important here is the business and the vertical and the market which you represent. Mastec has a large focus in UK and Europe, and they are in the insurance vertical. That surprisingly has come back. KPIT, again, a niche company, very strong in terms of the business they have. Very niche vertical in terms of the automatic stroke engineering. Another case here is Tata Elxsi, very differentiated in terms of the growth what they have. Now the conventional wisdom was that large cap IT services will command at a premium and mid cap IT companies will trade at a discount because they had poor margins and they will always struggle to get large deals and good talent. That is changing, folks. Now it's about talent, it's about ownership, It's about understanding the business, and it is about perhaps understanding the need and the gap in the market. It is no longer this arbitrage body shop model. Now what it means is, you will have to, now you will see a situation where the large cap IT companies, Anisha, they will become more like old manufacturing companies. They are big businesses, but they are mature businesses. Niche mid-cap IT companies, not all of them, but some of them will be high growth companies. Why? Because they are small and they are very focused in some of the businesses, whether it is machine design, engineering design, or automotive design, or the adaptation of EV. As a result, the P multiple in mid-cap IT now for next couple of years will actually be higher than large cap IT. What have we learnt in school, colleges, and over the years of television reporting? Large cap IT हमेशा premium command करेगा. They have the best talent, best brand, large orders. No, sir, that's not going to happen now. I think that is changing.
Anand Tandon as well joining in. And Anand, I don't know if you heard out Nikunj's view talking about mid-cap IT and the trend that we've seen historically, what we've witnessed in terms of numbers. What would be your take?
So as he says, there are specific verticals where you could get a certain upside because you are focused on that. Right now, KPIT is in a sector which the market particularly likes, largely because you are making a bet on EV vehicles coming up quite a lot in terms of overall market and market share. And that without doubt will lead to a growth for KPIT. But I think I would be a little reluctant to extend the same logic to every other company in the mid-cap. There is no doubt, some product that is being developed in some of the smaller companies which may be able to beat the general downtrend. But if you are a services company, there is no question that you will have an issue with the global markets being where they are. While Nasdaq has been outperforming in the US, you will realize that most of our companies are geared mostly to the banking sector, and that's the one that has been doing poorly. So if you are a services company with a preponderance of NBFCs and banks as your portfolio, you will be facing the same problems that the rest of the group has, which is that there will be some slowing demand, at least for the next few quarters.
Okay, and speaking of IT, Anisha has also sent us a very interesting, the most interesting perhaps press release that we've got from Coforge, Nikunj, and something for you to take heed. They crossed $1 billion in terms of revenues, and they're gifting an Apple iPad to each of their 21,000 plus employees. Where is our iPad?
I'm
Now
happy
he'll say,
to.
where's the revenue?
He's like $1 billion.
I am happy to give you other perspective. Forget the revenue. That if you take an iPad, that means you would be working from home 24/7. Do you really want that?
Working.
Do you really want that? Think about it.
We
That
do
means
have our
more Zoom.
laptops
That
and
means
phones.
more Zoom calls. That means
We'll
more
take a
links.
phone, chalo.
No. Working from home is only going to increase. Do you really want to walk on that path? Think about it.
Yes.
Think about it.
Okay, that aside though, not doling out any freebies, Anand, but let's understand what your outlook is as well when it comes to some of the other key earnings. We've discussed brokerages on SBI Life. They're pretty bullish, especially on the back of the fact that there's been a strong guidance for FY24 and for HDFC Life as well. What is your outlook in terms of the valuations, in terms of the structural business gains as well that the company has delivered?
I think, I have said this repeatedly in the past. Insurance, life insurance in particular, is a place I like. I think the runway is very large. Valuations can fluctuate up and down, but this is a this is a sector which you need to own and hold on for at least the foreseeable next decade or so. You will have that constant erosion of market share that LIC will be having. The private sector will be going up. It's a very, very long-term business where reputation of the owner is very important. Therefore, it is unlikely to be a place where some of the smaller companies and less known companies will be gaining any significant share. So over time, even that portfolio will get consolidated. So you're really looking at SBI, HDFC, and ICICI perhaps as the ones that will be left behind, and maybe a few others. But so I would think that with a consolidated industry, market share shifts public sector to private sector, you just hold on there. The valuations don't matter.
Suresh, minus hotels, what else is looking good? No Indian hotel, no Lemon Tree, no Mahindra Holiday.
Looking at a lot of public sector enterprises. That is where we are seeing a breakout. So GAIL India looks interesting. Power Grid is coming a percentage away from an all-time high. We are seeing the smaller names also do well. So we saw Gujarat PSEs do well. So overall, PSE is one segment which looks interesting. Second is capital goods space. Yesterday we saw Siemens at a new 52-week high. L&T is coming close to that. So L&T looks the most interesting name in the large cap space because that is a lot of catch up to be done over there. Similarly, the smaller names and capital good names continue to do well, whether it's a TD Power or a Bharat Bijli. We are seeing transformers break out. We are seeing even construction equipment companies do well. So anything related to capital goods is doing well. One stock which is on radar is again hospitals which has done well. Apollo Hospitals is the only one which has not done well. So there are multiple stock-specific ideas which one is looking at right now. But PSEs could be interesting because that is where momentum is coming up again.
PSEs is interesting, but Kunal, what's your take on City Union Bank? That stock will be in focus today because the MD and CEO has got the extension from RBI for 3 more years. And recently we have seen big moves as reaction to such news flow.
Well, in fact, the stock over the last 1 week was actually doing much prior to when the banking stocks, mostly the private sector banking names, actually start to get into recovery. Now, for example, from 125, 130, 125 odd levels, City Union Bank moved up towards 135. The screen reading for the stock, where we were looking at volumes for the stock price, the move in terms of the stock with respect to the overall banking stocks as well as the bank Nifty was much stronger. Now, hopefully, if the stock breaks past about that 135 mark, where it's been trying to consolidate for the last couple of days, I believe that this could probably open the gates for City Union Bank for almost 10 to 12 rupees on the upside. We could now be looking at a potential target range of 145 to 150 range for City Union Bank. I think last week or so when I had given a buy on City Union Bank, my targets were closer to 142. So I'm hoping that those targets could probably be exceeded by today, tomorrow.
The Economic Times today is reporting that the potential deal between Godrej Consumer and Raymond's. Now, Godrej Consumer and Raymond's, yes. Godrej Consumer and Raymond's. Now, Raymond's has a very large division which is focused on man care, so to speak. They were in talks to sell the brand to a clutch of PE investors and 2 startups. Given where startup valuations are, the deal actually fell through. The entire male grooming business is in Raymond's, in a subsidiary where the promoter has 50% stake and Raymond's has 50% stake. The Economic Times today is reporting that Godrej may be interested in expanding the entire product portfolio in the entire male grooming market, and there are advanced stocks for it. If the deal goes through, it means cash comes into the balance sheet of Raymond's. Now, Raymond, which for the longest time has been a puffy duffy stock, you look at the last 3 years, 5 years, it has just exploded in the last 1 year. A real estate, a branded apparel company has a real estate division, debt is coming down, and now they are looking at exiting their non-core businesses. So Raymond as a stock has really done what could be called as a pole vault in last 1 year. Am I right, Kunal? Absolutely. Pole vault is the word. Pole vault, remember? You've seen that spot? Yeah. Pole vault is you actually have a sort of rod and you go very high. Yeah. I mean, India's never had a pole vaulter. ऊंची छलांग नहीं लगाते हम. But globally, it's a very popular sport. I mean, that's what the stock is.
Long jumps, Anita, George, etc., but not pole vault.
Pole vault is, there is to be this.
So we believe in going long rather than going high.
Yeah, but I mean, the higher you go, the greater the fall is. Sergei Bubka. Thank you very much. Sergei Bubka actually had the record of breaking 35 world records, and those 35 world records were his own world records. So every time he would come out and beat his own world record, but technically he broke 35 world records. Yes, Raymond's.
Yeah, so I think interesting.
You forgot.
No. So from 400 rupees, because I've been tracking this stock very closely over the last 1-2 years. 2020 start when actually most of these stocks, whether you call it textile or real estate, I think when these stocks started to move up higher, Raymond was one of the late movers. So and I think 2021 in the first quarter or so is where the stock started to pick up decent pace, and that was a time when most of the real estate stocks, the textile names, they were actually going up for a bit of a plateau kind of a price range for themselves. But then Raymond rose up extremely sharply from 400 to I think 1700 almost 2 or 3 months back. From 1700, the stock in the last 2-3 months corrected towards 1125, 1150 mark, and now it's made a comeback again. So when you look at multiple time scales, whether it's from 2020-21 lows, whether it's 2023 lows, the recent low of 1100, the stock has performed exceptionally well on all of those time frames. I think that's a hallmark of a strong stock. So would be bullish on Raymond, even from current levels. That 1100 base which we tested a couple of months back, that would now be a more formidable medium-term support for the stock.
Yeah, it's pretty interesting with these ET reports suggesting that they are looking at the consumer care business, GCPL that is, of Raymond, Park Avenue and Kama Sutra brands, and this could give them a bigger play in the men's grooming category, especially in the premium end of the market. Earlier as well, they had the Good Glam Group. They had called off talks to acquire Raymond's consumer care business. This is only according to reports. So let's see. Today, by the way, there's an announcement by the management at 3:30 p.m. of Raymond. So maybe we'll get more clarity on that front. Okay, that aside, Anand, I wanted to get in your views then. Yesterday, we had a pretty interesting analysis on the new age tech companies. The fact that across the board names like Policy Bazaar, Delivery, Cartrade, etc., all have bounced back very smartly from their lows. But the only one was Nykaa that hasn't managed to do so. Lots of issues, rising competition, supply pressures, higher investments, a slowdown concern. Are all of these valid when it comes to Nykaa?
Well, it is valid. There is a question that it is one segment of the market on the retail side, and that's the valuations that the company came in at were very, very stiff, which is true for almost all the new age companies that got listed from private equity or PE funds exiting into the market. So at some stage, all these things have to be settled. Once you start making money and you start looking at the earnings multiples and so on, you will find that even now most of the companies which are promising to break even or have shown some cash break even will still look very, very expensive. I don't know about specific issues with Nykaa in terms of supply chain, etc. But finally, it is one niche market. It will settle down at some stage. To the extent that it has always been, or mostly been a profitable company, at least there is some a parameter that you can use to figure out where you want to be. For most of these businesses, I think there is a lot more maturity needed, both from the point of view of the management, the kind of organization that they built up, the people that are working for them, and the optimization in terms of their salaries, before you could argue that these are stable businesses that need to be valued. At this stage, while Nykaa has one thing going for it, that is that it addresses the higher end of the market, and that's the consumer discretionary space almost that is likely to do well given the current macro that we are in. I think there are easier ways to play it in the form of, either consumer durables or perhaps even two-wheelers, etc., or four-wheelers.
Anand, I also wanted your take regarding a couple of these stocks. Result reactions, of course, today. Voltas, that has been one stock which has been disappointing with respect to its earning quarter after quarter. But we don't see a sharp decline in that one. It continues to be between that 800 to 900 rupee range of late. And Shoppers Stop, which has been a bit of a turnaround story this year, or rather this quarter, reporting a profit versus a loss this time.
So, Voltas, as you said, hasn't actually delivered anything worth talking about for a reasonable long time. But I think the pedigree of the group kind of keeps the valuations high. And there is always some belief that, going forward, things may change. On the other company that you mentioned is which one?
Put a sum total of the commentaries which we've got from the managements of consumer-facing companies, Tata Consumer, Nestle, HUL. Hopefully later this week we'll talk good things. HUL is today, right?
Yes.
HUL later today, yeah, not later
during
this week. During market hours. There seems to be a turn coming in. Kunal, is Tata Consumer coming out of that 1 year long hibernation? It was 750 same time last year, now 750 again.
Well, yeah, I think it seems like, Nikunj, because 2 days of very strong volume action for Tata Consumers, that generally, and when it happens during the expiry week, and the stock breaks past about some certain resistances, it manages to catapult towards a strong favorite for the forthcoming series. And I think that's going to be a very important factor for Tata Consumers. Now, the important point is that I think last week or so, or maybe a couple of days back, most of the FMCG stocks, in fact the FMCG index made a fresh 52-week high, lifetime high for itself. But then this comes at a point where the likes of HUL, Tata Consumers, etc., these stocks are nowhere close to their life highs. So I think it's the sector trend which is also trying to push many of these stocks, or rather pull these stocks higher from where they were over the last 1 or 2 months. Hopefully, I would expect, say, post results, HUL could also make a strong comeback for itself. Tata Consumers breaking past about that 700 mark yesterday or day before, I think now could probably catapult itself towards the 800, 850 mark. So I believe slowly and gradually, most of these other beleaguered FMCG names, which have actually underperformed in this leg of uptrend, they could try and pick up pace for themselves.
All right, just taking or standing by for a few seconds as the pre-open rates as well will kick in. Not just that, we've also got an ET Now news break that's lined up for you, so we'll get you lots of perspective on that front. What about capital goods, Anand? What's your outlook within that space? Will you be exceedingly selective? And if I could extend it across the board to names within the railway space, for instance, we've been seeing the likes RVNL, IRCON, they've all been a buzz of late. What's your outlook, given that a lot of experts have been alluding to the fact that the capex cycle is strong, the orders, the order booking as well is looking very encouraging?
There is no doubt that it does look like the order books are good, and most of the commentary generally has been quite positive. But I can't think of too many large cap companies that funds could be buying, other than perhaps Larsen, and which is why Larsen trades at the kind of premium that it does. So you would find that while you may want to buy some of the capital goods companies, the valuations are already reflecting whatever their order books are and a lot more. So there isn't that much value left. On the railway side, there is no question, with the 2.5 lakh crore kind of capex budget that the government has announced, or the overall railway budget, there will be a lot of order flow coming through. And some of the companies like RVNL, etc., which are largely consulting businesses, besides, of course, having some of their own assets, but mostly consulting businesses, which is where the growth has been, will obviously be beneficiaries, because you will have a lot of studies to be done before this capex is going through. But they would probably be, they should have been lead indicators. They should have been making the money before the capex was really announced. And therefore, what you're likely to see is the end role that they're playing today. So unless you are making a point that, the kind of railway budgets will continue for the next several years, you may find that it's perhaps better to look at the suppliers today rather than the consultants.
RVNL yesterday traded more than what Reliance traded on the National Stock Exchange. The volumes yesterday were 11 times more than the 20-day average. And this is the second highest weekly volume RVNL has actually ever registered. It's become a Navratna, but that does not change the financials for RVNL. The question is that, is there frenzy in the market? And if there is frenzy in the market, should one avoid into the stock? Because just because the stocks become Navratna, I don't think the business gets re-rated. Opinion gets re-rated, you become core of the companies, but that does not change anything incrementally for the earnings. So the re-rating in the stock, if it has happened because it's become a Navratna, I think it's not justified. Kunal, it reversed yesterday. Has RVNL, the darling of this week, has it peaked out in the near term?
So in the near term, yes, Nikunj. In fact, I'll go back to 2 instances for RVNL when the stock actually moved up more than 40% to 50% in a matter of few trading sessions. The first was in October 2021 when the stock moved from 30 rupees to 44 rupees, I think in a matter of 3 or 4 trading sessions, again on the back of such similar kind of spike in volumes for the stock as well as trading activity. What happened post that was, for a period of almost 1 year, the stock remained sideways. It remained in the band of 35 to 42 approximately for that kind of a time span before it moved on higher and got into that breakout. Second half of 2022, again a very similar kind of a move, October, November 2022, where the stock moved on from 36, 37 rupees to almost 72 in a matter of 1 month or 1.5 odd month. So again, strong volumes, excellent price breakout for RVNL. What happened post that? 3 months of consolidation, 4 months of correction for the stock price. So I would expect that it all depends on what one is looking out for. If it's an immediate short-term play, then maybe yes, the stock could have peaked out over the very short-term charts. It may go into such a kind of a time-wise correction where it may remain plateaued for say another couple of months. But then if someone is looking out for more of long-term, say 1 year, 2 year plus kind of a time horizon, then these consolidations which may come by should be taken as opportunities to buy.
Okay, there you have it. That's the analysis on Rail Vikas. But let's move on and get in those strategies as to what exactly those mid-cap ideas are from our chartists and what they're betting on today. And Naresh, what's your bet?
So that's a buy on Federal Bank. The stock has given a breakout yesterday from the triangle pattern. Over the last 6 months, the stock has made 3 bottoms around 125. The recent high around 135 has taken out. Stock has been showing a relative strength compared to the rest of the small cap banking names. One of the few stocks which is closer to an all-time high. It's just say 5% away from an all-time high in the small cap banking space. So expecting a fresh move towards an all-time high. A stop loss at 130 and a target price of 150.
Thanks for joining in, Anand, and giving us your take. Those are some of Naresh's mid-cap strategies. Kunal, yours?
So there will be a buy on Gland Pharma. I think after yesterday's price action move as well as last week's price action move where the volumes jumped up significantly for Gland Pharma, I would expect that maybe the stock is at a cusp of a turnaround. Taking a risky bet over here, suggesting a buy 1550 as a positional target, which means another 170 points on the upside is what I'm expecting. Stop loss for this trade could be kept at 1280.
Okay, so that's the take coming in as far as the stocks are concerned, and what are the top mid-cap strategies coming in from our technical experts as well. But we are talking to you about a corporate news break, which we are, highlighting at this point of time right here on ET Now. In fact, we learned from sources that IDBI Bank disinvestment from government and RBI sources. The government hopes to complete the divestment by December, and financial bids will be invited by July itself. The RBI sources say that the regulator has completed the due diligence by the 4 bidders. Let's go across to my colleague Prakash Priyadarshi to understand how the government is ready for the divestment at this point of time.
Yeah, sources are informing that the disinvestment process of IDBI Bank is moving in the right direction, and government is hopeful to complete this whole process by December 2023. DIPAM is expecting to receive multiple financial bids for IDBI Bank, and due diligence on queries raised by investor during EOI stage are being done at the moment, and it will continue during the second stage as well. We are also given to understand that DIPAM is planning to invite financial bids for IDBI Bank by July 2023. Sources are also informing that all the important factors, including global and domestic, will be taken into consideration before inviting financial bids. Since disinvestment of IDBI Bank is a unique kind of transaction, so detailed and careful evaluations are being done at every stage, including security clearance of prospective bidders. Government is upbeat on good response from investors so far, and then hopeful to complete this whole transaction by end of this year.
All right, in fact, now let's take it across then to Ankur Mishra, who joins in with the update on the RBI clearances. Ankur?
Yes, sources say that Reserve Bank of India may have given an in-principle nod for the potential bidders' due diligence in the case of IDBI Bank. What we have learned is that at least 4 of the 5 potential bidders may have got a green signal from Reserve Bank of India, and the rest due diligence is still underway. Sources also indicate that this nod is not the final, but during the process of divestment of IDBI Bank, the due diligence by the regulator will continue, and as and when it is required, the regulators will reach out to the potential bidder for any clarification, if at all it is needed. As far as the stake sale of IDBI Bank is concerned, we understand that the access to the data room will be given to the potential bidders very soon, so that they can go through the details of IDBI Bank, and then RFP will be given to them, so that the final bid can be submitted by the potential bidders, and that is also expected very soon. But all in all, what we learn is that the preliminary work of Reserve Bank of India is completed by now, and we may move to the next step of the divestment of IDBI Bank, and soon we may see that more than 60% of stake of government and LIC may be reduced in IDBI Bank.
Okay, so that's the big news break that we're bringing for you on ET now. So IDBI Bank divestment, it's been long overdue, long overdrawn. So let's see when that finally happens. But in the meantime, let's get you some other news flow as well. What's happening across the globe? Shares of Facebook parent Meta zoomed after the company surprised street with an increase in sales for the first quarter, largely led by their Realty Labs unit, which brought in $339 million. Sales were up 3% following 3 consecutive periods of revenue decline. A better than expected revenue guidance issued by the company between $29.5 billion to $32 billion range is something which got the street excited. On the other hand, Samsung's profit plunged in Q1 amid the weak demand for memory chips. Forecasting a massive slump in profit earlier this month, company said that it would be making a meaningful cut in the memory chip production. They have, however, given a go-ahead to flag a recovery in chips over the second half of the fiscal. Profits fell to $478.6 million in the quarter gone by, and that is a 95% drop and the lowest for the last 14 years that we have seen in any quarter for Samsung. New Bank of Japan chief chairs first Kazuo Ueda policy meeting. UAD is expected to maintain the ultra-loose monetary policy of the predecessor for now, but expectations are that he will plot a path out of the policy in the future.
Meantime, Amazon has started laying off employees from its cloud services operations amid the slowing sales growth. The US, Canada and Costa Rica employee base were notified about these layoffs via email. The company just wrapped up a round of job cuts earlier this year that totaled to about 18,000 people, and now another 9,000 layoffs in the month of March. And then added to that, you do have the AWS cloud division as well, which is seeing layoffs. Moving on across the globe, Ukrainian President Volodymyr Zelensky has spoken with his counterpart in China, Xi Jinping, via a phone call. This is the first since the war struck Ukraine in 2022. The call was quote-unquote long and meaningful and might be able to encourage better ties between Beijing and Kyiv. Now, according to media reports, China is set to send representatives to the war-struck nation and hold dialogues. Meantime, in the latest on the Operation Kaveri, over 500 Indians have been rescued from the crisis-stricken Sudan so far. The latest group of 360 Indian nationals were brought home last night. Earlier, the naval vessel INS Sumedha reached the Jeddah port with 278 evacuated passengers. Another batch of 136 passengers were brought home on Wednesday in an Indian Air Force aircraft.